Hello, everybody. Welcome back to the Trading Room. I'm Shane Vernier, and this is our commodities trading workshop, I guess. I mean, this is absolutely garbage with the technical difficulties. This is the sort of what streaming is. It always seems that something somewhere always seems to get in the way, and this time it looks like some audio and video issues that have to do actually with the hardware that we're running here in the room, which is surprising because it's extremely expensive, and all of it seems to work usually. So good to see everybody back. I think everybody's back and ready. I don't know if the microphone's working correctly right now. It looks to me like it's pretty hot, so I don't really know exactly what the sound's looking like. But if you guys are, in fact, if you can hear me all right, and if we're ready to go, then just give me a thumbs up here. I'm looking at the How to Trade Trading Room. If you're interested in taking in the learning how to trade commodities, I'm going to go ahead and run through it. But I get frustrated with technical stuff. I've been working with technical stuff all day long, and it's just been one headache right after another. Seems like if there's not a server issue with Cloudflare, it's always something that's local hardware-wise, and you can never run enough checks, and it never seems like you can get all the kinks out of it. 9 times out of 10, everything runs great, but that 10th time, it's just an absolute mess. All right, all good. I appreciate you hanging around, Lita. I know that it's a challenge, and you absolutely hate waiting. Good to see you in the How to Trade, or excuse me, out there in YouTube land. Tina Jing, good to see you. And Andy Tong, welcome. My apologies for the technical issues. Absolute garbage. I'm going to do my best to get back on track here. We had a pretty big show sort of lined up for you here on how to trade commodities. We're going to run through some of the keys. I do appreciate everybody's patience, though. I tell you what, not very many things in this world make me angry anymore. I've seen enough at 46 years old. I've seen enough. I've had enough really great things and enough bad things and enough tragedy and enough happiness where I've seen it all. I mean, I really can sit here and say, yeah, I've seen a lot, and I don't really get mad at anything anymore. I lose a trade, I feel bad about it. I lose a big bet, a big sports bet or something, I feel bad for a little while, but I don't necessarily get angry. And, people cut me off in traffic, I don't get angry. People cut in front of you in line, or somebody's really just rude and an idiot, I don't really get angry anymore. I don't know if it's a state of zen as I get older, but for some reason, technical issues on these streams piss me off to no end. So I do appreciate you guys hanging in there. My apologies for wasting your time. I cannot stand that. I do not like wasted time. Wasted time on my end of things is absolutely unacceptable. And I've been trading long enough to understand how much value 5 minutes can have. So that's why I get frustrated. Maybe I'm just crotchety in my old age. I don't know. All right. Let's find our Zen point and get it on. All right, guys, good to see everybody back in the room. My apologies for the technical difficulties, but let's go ahead and move forward. It looks like my microphone's working and everything still looks like it's running really hot, and I've got it turned all the way down. Well, we'll see what happens here, guys. All right, let's go ahead and dive in and see exactly what we got. Remember, if you want to trade anything that you see here today, head on over to Switch Markets. Check it out. We've got the Black Friday deals that are definitely there. If you're leaving already, Black Friday gift now. There's all sorts of gifts, bonuses, really everything you need. 2 days, 5 hours, 50 minutes left in that sale. It's not really a sale because they're just going to give you a bonus. But remember, this game's all about money, and the more money you have to trade, the better chance you have to trade successfully. A couple of things we want to start off with here. Let's go with a trade update. I put this one out earlier today. This is the U.S. dollar, Canadian dollar. Pretty good little buy here, and the reason why we focused on the Canadian dollar was because it's a commodity dollar. It's a COM doll, and what we mean by that is when you talk Canadian dollar, you talk crude oil, and I'm going to show you all the ins and outs of crude oil here in just a second. But this is definitely related to WTI crude, West Texas Intermediate. We had a nice support zone really developing here on the monthly. I love the 13-month EMA down there at 139.28. We've also got really a one, let's see, what else do we have? We've got the 38% retracement right there at 139.10. So we had a nice little buy setting up for us right above 139. I think that's a very strong trade. I would be surprised if the Canadian dollar gets much strength off of crude much longer. U.S. oil's up about 1% today. And a lot of that is just sort of what I would call, I won't say it's foolhardy, but it's definitely not really indicative of what's going on in the market. Venezuela is the word of the day here in the United States, and everybody's waiting for those strikes. That's what's propping up WTI crude. There's no question about it. So I'm looking to sort of play this one to the bull. I think that if we get an opportunity to buy down there right around 139, I believe it was 139.14. That's what we're looking at, 139.15. That's the area that I'm interested in. You got a real strong support zone there and an opportunity potentially to get a little bit of money coming in ahead of the holidays, and we can always use that, right? So we definitely want to be ready to rock and roll on that U.S. dollar, Canadian dollar. And remember, WTI crude is going to give you a big hint into what's going on in the dollar CAD. All right, let's go ahead and get on with this. We sort of are just off to a rocky start here. You can see week 49, S&P Global PMI Monday, CPI. Today was ADP non-farm employment change. That was really the big number. You right there, negative 32,000. Horrible number for employment. You can see that our graphics are messed up today because of the problems here with OBS. But ADP non-farm employment, a horrible number. Crude oil inventories came in a little bit above expectations. The biggest thing to remember about crude oil inventories is they're very important when it comes to crude oil. If, in fact, you do get into a situation where you're trading crude seriously, you need to remember that 10:30 a.m., Wednesdays, sometimes Thursdays on a vacation week, or if there's a holiday on a Monday, that's when the EIA number drops, and that's a monster. That's a really big one. You've got to remember that. Today we saw a build. Theoretically, that's exactly what we're looking for. These numbers are not necessarily correct. Negative 1.9 million is what we were looking for there. The reason why we were looking for a draw on supply is because of the Thanksgiving Day holiday travel. Typically, you see those supplies drop for Thanksgiving week because of all the travel, the people driving, all the airfare, all that jazz. We didn't see it this year. That means production's coming back online in a big, big way in the United States, and I think that could be a major market driver for WTI crude as we move into the winter months. So I'm bearish. This really does paint to my bearish picture, but we're rallying, so I'm not going to sit here and say, oh, we're going to come off eventually. I know we're going to come off eventually, just don't really know when, and that's what our technicals are for. Okay, let's talk a little bit about commodities and how to trade them. First of all, what is a commodity? A commodity is a basic good or a raw material used in commerce, such as agricultural products, wheat and coffee, energy, oil and natural gas, and metals, gold and copper, silver, things like that. All you got to remember about a commodity is two things. Number one, it's a raw material. It's something that you build a good out of, you build a product out of. And then number two, what it also is it's something that's priced according to what it's going to be worth two ways: futures contract, spot contract. We price on the spot market what we could buy it for cash today, and our futures is what we're going to buy it for next month or what we believe it's going to be next year. The futures market is more important than the cash market. I'm going to tell you right now, the reason why a lot of these CFDs are based on the futures contracts. Very important if you're going to trade commodities that you understand what futures pricing is, because it's the basis for CFDs. It's also the basis for many trading strategies that address the concept of time. They play spreads, they play options, they play all sorts of hedging things they can do, and it's all predicated upon time. Commodities and time. You should think of them as one thing. Commodity, as soon as I hear the word commodity, I'm thinking about time. Why? Because it's not necessarily what a bar of gold. I had some copper right here. It's not necessarily what this copper is, what this ounce of copper is worth right now. It's about what it's going to be worth next month. That's what gives it the value to traders. That's why it's valuable to us. The only reason why we care about commodities is because they're liquid and they're volatile. And as soon as we get in on that volatility, then we start making money. And that's really what it's all about. So I'm interested in a lot of different things when it comes to trading. Commodities are my specialty. I trade gold futures and crude oil futures. Those, I would say, are my bread and butter. And I also like trading the equities indices. I think those are pretty good to trade as well. But as far as I'm concerned, you can make a living trading commodities and nothing else. Are commodities different from other assets? Yes, they're far more volatile than the Forex pairs. They're far more volatile than a lot of things that we see on the stock market. So you definitely want to be aware of what a commodity is, but the only thing you need to know is that it's a raw material, all right? It's an earth-born raw material. And number two, it's something that we use, or it's something that we price according to what we believe it's going to be worth. That's it. That's all a commodity is. People get really flustered and scared by commodities. You don't need to. Commodities are your friend. There's a lot of opportunity in commodities, and a lot of market drivers impact that opportunity. All right, so key commodities. What we're going to be looking at today is energies, natural gas, and crude oil. Also, metals is going to be gold, silver, and copper. That's absolutely key. Agricultural commodities, corn, soybeans, beef, and pork. We're not going to spend much time on ags. I'll pull a corn chart for you and show you exactly where to find it. We'll pull a beef chart too, because those are pretty interesting right now, just because it's so, the market is just so overbought in beef, and a lot of that has to do with tariffs, trade restrictions, and all sorts of things. But we're going to look at those as well. The keys to commodity trading are threefold. It's very easy. Volume. We trade commodities when there's volume in the market. Typically, that's during the U.S. session. Number two, volatility. Commodities are inherently volatile, and it's because we price what we believe they're going to be worth in the future. Remember, it's an old saying, sort of an inch at a foot is what? A foot at 12 feet, something like that. You've got to remember that a little thing that impacts commodity pricing today could make major swings within a month. We're here for the volatility. We're here for the action. We're here for the money. That's why I trade commodities. I like action. You can trade commodities every single day on an intraday basis. I haven't got into much of it. We're going to show you a little bit today, but volume and volatility is what it's all about. I recommend if you're going to be trading commodities with a CFD product, tight spreads, and we're going to show you 2 of those, actually 4 of those overall in our switch markets MT5 here in a second. And fundamentals, the last thing I'm going to tell you is fundamentals. If you're going to trade commodities, I don't believe that you have to be a fundamental trader. You don't need to understand seasonality and all the market drivers that bring everything into play. You don't need to know that. But what you do need to do, what you must understand, is that when these things hit the market, when these news events hit the markets, volatility is usually swift, and it can be reckless, and it can absolutely take all your money from you in a hurry. Weekly EIA crude oil supply numbers. If you're going to trade crude oil, you've got to know when that number comes out, 10:30 a.m. Eastern on Wednesdays, sometimes on Thursdays at 11 a.m. Eastern, only on holiday weeks. Every week, check your economic calendar. If you're trading crude oil, it's almost always on Wednesdays. All right. The second thing, natural gas, EIA natural gas report. That's always on Thursdays. You've got to know that the action in these markets is absolutely huge surrounding these news releases. If you're trading any sort of agricultural commodity, and I mean any sort, you've got to understand when those commodity reports come out. There's a lot of them that come out from the USDA. You've got monthly, what are those monthly USDA reports? Those things shake up everything in the commodities market. So you've got to understand, they're WASDE reports, the World Agricultural Supply Demand Estimates. That's from the USDA. Those come out every month. You have to know when those are released. You'll get absolutely slaughtered if you don't. So commodities, fundamentals, you can sort of get away with not ignoring fundamentals on your Forex pairs as long as you know when a central bank is supposed to speak. You can also get away with it when you're trading stocks. You don't have to be that fine. You have got to know it with commodities. Understand those key releases. Understand that they will shake up commodities in a major, major way. So let's go ahead and get it right out to price action. I'm going to go ahead and show you a few of these. Now, from the Forex, anything that's based on a commodity, any currency that's based on commodity pricing is called a COM dollar or a commodity dollar. The U.S. dollar, Canadian dollar is one of them. The Australian dollar, U.S. dollar is another one of them. The biggest thing to remember about commodities in general is they are primarily priced in U.S. dollars. That's absolutely key. They're primarily priced in U.S. dollars. So when you show up to buy an ounce of gold, typically it's done in U.S. dollars. When you show up to buy a barrel of oil, it's done in U.S. dollars. Now, this may not be the case till the end of time. It really may not be. We may be pricing assets and commodities in anything moving forward. We're going to focus on the U.S. dollar because that it has been the benchmark for about the last 100 years. Not quite 100, but about 80 since 1944 after World War II. So you're going to want to remember that. All right, here we go. Let's look at some of our top commodities here to look at. The dollar CAD, we already gave you that. That's a commodity dollar. Let's go ahead and start with our energies. That's sort of my repertoire. U.S. oil is a big one. Your U.S. oil CFD. Also your U.K. oil CFD. Now, U.K. oil mirrors what we call the UK oil mirrors Brent crude. Okay, that's absolutely imperative that we understand that. Also, U.S. oil mirrors WTI, West Texas Intermediate. Now, if you go on over to our CME group, you'll see or you'll remember that the key markets that these two things mirror are going to be what? It's not going to be Brent crude. Brent crude is going to be located on the ICE exchange. But WTI crude, that CL contract, that is absolutely what we're talking about. WTI crude is a big one, especially when it comes to your U.S. oil CFD. This is what U.S. oil is based on right here. WTI crude oil futures. You've got to understand that this is a volatile market. It's a deep market. I've been trading crude oil for a long time. And if you're an oil trader, then you know what I mean. They used to call it the Wild West of trading. I'd say, boy, the E-mini NASDAQ probably is that now. But this is a big deal. So when we're pricing crude oil and we're pricing pretty much everything to do with oil, you're always going to be looking for your front month contract. In this case, it's January. We're trading Jan. These numbers are delayed, but you're looking at 59.19 volume. The reason why it's the front month is because it has more volume than the other contracts, which are more deferred out in the future. So when we're looking at this, January. So what does that mean for U.S. oil? It means this U.S. oil CFD is tracking that January contract. All right, now you said, well, it's 59.19. Those are delayed. It's right. It's trading right around 59.31 right now in real time. U.S. oil's at 59.32. So if you're going to trade right now today, we sort of put this analysis out there. I'm still looking at yearly lows in U.S. oil, somewhere down around 55.15, 55.25, a pretty good entry. We have a Fibonacci retracement sequence. We would love to sell up there at 60.50. I would love it. That's sort of your broader look at what my game plan would be going into a week of crude oil. Now, for today, let's go ahead and take this down. This is our futures contract. We're going to go ahead and throw this up on a 30-minute chart. And what we have here is about 59.31. Now, 59.31 is a big deal. It's a big deal because it's the point of control for our U.S. session. There's no question. He says, Shane, when do you begin trading crude oil in the morning? About 7 a.m. my time, 9 a.m. Eastern. That right there is typically the opening bell ding-ding. Now, we had some good action about 30 minutes ahead of that, but pretty much every day you see business pick up right around 9 a.m. Eastern, 30 minutes ahead of the cash open, and then you'll notice that these volumes are relatively solid throughout the trading day. They die down a little bit during this period. They're going to pick up in about the next hour. You've got about another hour of premium trading when it comes to WTI crude oil futures. Now, as far as what we can really do and what we can expect out of this chart on a daily basis, you're going to have an opportunity to get decent moves. You will. You'll have an opportunity to get some decent moves. Will you be able to get them consistently? Sometimes crude oil goes quiet. And one of the things that I always do is I always look at a daily range. So I look at my daily range and I'd say, okay, what is it right now? 59.64 down to 58.37. So we're looking at about 127 ticks. That's pretty tight. That's pretty lean. I would take a base average. I would probably put an ADR on this, which is an average daily range. So I would be looking at average daily range right there. And I'm going to give you some secret sauce right here because you guys bared with me. My ADR settings, 13. So for the previous 13 days, I want to know the average daily range. So when we're going to go ahead and do this, I don't want this in a histogram formation. I can't really talk much more about the range numbers because a lot of that is proprietary. And I could very easily get sued if the wrong person's watching this right now, believe it or not. But I don't care. You guys sat in there through the technical difficulties, so we got to give you something for your time. So I've got an ADR down here, right? Your ADR, going into yesterday's session was about 146 ticks. So that's an average of the last 13 days. That's sort of your average range. That's my baseline. That's where I'm trying to figure out, okay, what could today's range look like? And I'd say, okay, coming into today, we've been running about 146 ticks. Right there, we're looking at 59.64 to 58.37. So I'm looking at about, 127. So there's a little bit of room here to make a high or a low. I don't really have a problem with that. We could push either side of the equation. So when we go back to our 30-minute chart, we say, okay, what could really happen here? It's very tight. It's a very tight range. You can see exactly what happened. All of our movement came during the London session where we got a nice big run up, probably reacting off of something out of OPEC. And now we're rotating sideways. What would I say would be the best probably way to trade this? Right now, we are in complete rotation. I mean complete rotation. Let's take this down to a 5-minute chart. At this point of the game, this strategy could be as easy as just buying the lower Bollinger Band at 59 and selling the upper Bollinger Band. Look how flat everything is. So to sit here and try to pick a direction in this market is foolish. And this is one thing about commodities, is when they quiet down, you got to go find something that's active. So that's a good look at how I would be approaching the WTI market today. Probably nothing here for a late day trade. Let's go ahead and look at UK oil. Now, UK oil is a little bit different. This is North Sea Brent. The futures contract that's based on is going to be off the Intercontinental Exchange, the ICE exchange. I don't trade North Sea Brent, UK oil. This is a more global view of a more global view of crude oil. A lot of people like UK oil more than WTI because it sort of reflects global supply and demand, as meaning a lot of things out of the Middle East. The UK oil is impacted by. WTI is as well, but typically North Sea Brent is your international view of oil, and typically that's a little bit higher than WTI. So today we're running UK oil right around $63 a barrel. How would I be looking to trade it? Really similar. Right here, if you're trading UK oil, you're probably looking at the yearly lows, and if you're not, you should be. Your low right there is 58.44. Your low right there is 58.74. So you got about a 25 or 30 pip range down there where you could be looking to take a bid probably from 58.50, somewhere in that zone. Probably relatively a safe scalp, at least, to the top side. Is the seasonality the same in UK as in US? Typically, yes. Typically, yes, we're talking about demand from the northern hemisphere. That's where a majority of the consumption comes from, is the northern hemisphere. So you're going to want to definitely be tuned in with the seasonality. Seasonality for energies is relatively simple, especially crude oil. You're going to see higher pricing in the summertime in the northern hemisphere, lower in the winter. It's basically all there is to it. Now, one last energy before we move on is natural gas. Now, this is a 920 EMA crossover. This natural gas has been absolutely phenomenal. This trade, I mean, anybody that remembers it on the daily, the 20th of October, this thing absolutely exploded. It really just took off to what I would call just an amazing trend trade. I love this because you're 20th of October. You know you're coming into bullish season for natural gas. Natural gas is different than crude oil in that in the wintertime prices rise and in the summertime prices fall. Well, right here you have the signal of all signals. Even this was a great signal back maybe on the 30th of September. He took a bit of a draw, but then bang, you're right back on the horse. And we went up to just a fantastic level, which is back in play today as topside resistance. So let's go ahead to our monthly. This is a Fibonacci retracement sequence that I put out there a lot over the past several years. And the reason why is it probably has defined natural gas for the last decade. I mean, let's be brutally honest. That run up was as Russia went into Ukraine and the world reacted. Sanctions, stopped exports, all of it. You're up there right around, 99, 95, something like that. And you can see we topped out, and then we came all the way down to these incredible lows. You know, you said, Shane, the world's at war. The fundamentals all speak to the long side of this market. Why? Why, oh, why did natural gas crash the way that it did? And the answer is complicated. But the first thing I would say is it had to do with Russia pegging the price of natural gas to the ruble. If you were going to buy natural gas, you were going to have to do it in rubles. That was a real interesting thing because that changed the dynamic. It really made all the sanctions the West brought moot in a lot of ways. So when we saw that, what is the price? If you're buying your natural gas in rubles and you're doing business in rubles, what does natural gas cost in terms of dollars? Cost a lot less. It was really an incredible move from Russia to combat the sanctions. They came in and they pegged the price of natural gas to rubles. And then, they didn't peg it. They said, listen, we're doing business in rubles if you want our gas. And they said, okay. And then they inadvertently pegged the ruble to the price of gold, at least on a fractional basis. I won't say it was a genius move, but it definitely mitigated the negative impacts of most of the sanctions you saw out of the last administration. And what it did to natural gas is absolutely cratered the price. And then you got a little bit of a rebound here. But this level was the line in the sand. And what I wanted to highlight here, 47.38, 38% move of that Russia-Ukraine invasion of the Ukraine. And then this bottom down here back in 2024. We rallied up. We sold off right there beautifully. We sold off again. This is a chart that I've shown probably for the last 2 years. It's a good one. It should be on CNBC. It's not. Keep a close eye on this, though. If you do get a breakout above last month's high, which is right around 47.56, we've got a high about 47.34. This is where the real bull market for natural gas will begin. If you're trading natural gas, right there, that's where it's going to blow up and that's where it's going to begin. So what is the price of natural gas really predicated upon? It goes back to your futures contract. You go to your CME group here, Chicago Mercantile Exchange, the biggest market in the world essentially for futures. It's not as big as Forex markets, but it is very, very large. Features products, you go right here. Henry Hub Natural Gas is what you're going to be. This is the primary instrument that decides what really natural gas is worth. Probably the largest gas futures contract in the world. One thing I want to point out about this, it's printing about 4,969. That's a lot higher than your natural gas CFD that we look at. Don't worry about that. It's a little bit of a discrepancy. This is interesting, though, because when you go to natural gas and you look at the quotes, the biggest thing I want to point out is it's not that deep of a market, meaning crude oil typically trades with much more volume than natural gas does. Natural gas can really hurt you if you're not careful because it is what we call a thin market. Now, a lot of folks call crude oil a thin market, and it is compared to, say, the Euro USD. But natural gas is thinner than crude, and it can be an absolute disaster zone if you're not necessarily sure what you're doing. Be very, very careful when you're trading natural gas. If you're hanging around when a supply number is dropped, you could be in big, big trouble. So remember, Henry Hub Natural Gas is sort of the base asset for a lot of these CFDs. Have a close eye on that and keep a close eye on when we roll over. Like right here, we're at front month is January. We're looking maybe to roll to February. The big thing I would be concerned about is when we roll to February to March, those natural gas prices are probably going to start coming down a little bit. And that's because we're heading into springtime seasonality. All right. So what we have here is natural gas and WTI crude and UK oil. Probably your three biggest energies. We've also got heating oil. We could talk heating oil if you want. That's sort of a difficult one for me to talk because it's a very thin market. Also gasoline. When you talk gasoline production, a refined fuel, very, very thin market, much, much thinner than crude oil, natural gas, even heating oil. So I'm going to steer clear of those discussions because meaning gasoline isn't really a commodity. It is in the sense that you have to have it, but it's not in the sense that it's earth-born. It's refined. So a lot of folks say it's a commodity. I don't consider it a commodity. I consider it a product. So we'll cover those some other time. But heating oil and gasoline, those are dangerous markets. Be very careful if you're trading those. Okay, so that's a good look at our energies. The next thing we need to look at is our metals. Now, most of you, or if not all of you, are familiar with our precious metals. And essentially what we have here is gold and silver. Those are two pretty good ones. Now, a lot of what we see pricing-wise from our gold and silver products are basically, the view of gold and silver as it's priced today. Essentially, that's what a spot price is. It's what I can go down and buy an ounce of silver for right now. Futures are different. These gold and silver spot pairs, they don't really reflect the futures pricing. So if you're interested in trading the futures contract, you just go back on over to that CME group, and you go right there to your gold. Click on gold. They've got copper as well. Silver's a huge contract. You probably can't afford to trade that. The margins are huge. But something like gold, you definitely is just an incredibly popular contract. I trade full-size gold. I think that it's really a great commodity, and it gives you incredible volatility and incredible opportunities to make money every day. But you'll notice, you're printing about 42.31 right there, and your spot market's printing about 4,200. So there is a big difference in these gold markets, especially when it comes to futures compared to your spot. So something like this, you look at the quotes, the game is still the same. You want to trade your front month. Right now we're trading February gold futures. We're on 152,000. You'll notice December, which is right around 4,200. That's sort of where the spot market is. There's no real volume there, so it's going to be really tough to get filled, to get in and out of the market. Be very careful with anything that's low volume, low liquidity. So what you have here is what? Well, you've got your gold and your silver charts. So we've got our gold weekly. We've got our silver weekly. We feel pretty good about the uptrends in these markets. We had that breakout right there. If we go back on over to our trading view, we've got that breakout on our trend line, which essentially looks to me like it's going to be probably the trade of the month. We're looking for a pullback here, though, about 41.25-ish. If you do get the 41.25, then, yeah, you got to buy it at this point. But that's $75 down the queue. I don't really know that you're going to get that number. I think that you're probably not going to get any more of a pullback than we already got. So to open this month's trade, we had a fantastic opportunity there to step up and really bid somewhere right around, just above 50, 41.63. This is why it's trading. So you really have probably another 2 weeks to get this trade. If not, probably not going to get it this year. Pretty good stuff though. Nice trend line, broke above the trend line. Now we're waiting for a pullback. Really a beautiful trade. As far as silver goes with our analytics, our double top that we had, sort of there was our cup with handle on the weekly. There's your cup. And it was a better daily. I'll show you it on the daily, but your double top was very just emphatic right around about 54, 42, somewhere in that zone, and that was your cup with handle. Cup with handle pattern, no question about it. Top right there, 54, 48. Top right up in here is going to be 54.39. Then we had a cup with handle and then a break. Once we got the break out of that handle, probably right there, first big green candle after the pattern. You're rocking and rolling and pretty much waving to the crowd as price goes by. So I'm definitely interested in silver moving higher. I think that it could be a real challenge to hold this position, depending on where you're long from, just because we're starting to see some compression. One thing that you have on the daily, though, and it's going to be a situation to monitor, is you do have a bullish pennant setting up. So something like this. Is it pretty? No, I'm not an artist. Is it pretty good? Is it still setting up? Yeah, it is. It really is. So if I was drawing this, This would look something like this at this point. We would be really working off of this weekly low, December 1st low, and then right off of today's high. And if we sort of rotate in that range, the question really becomes, okay, Shane, how are you going to trade it? I'm looking for another leg higher, no question about it. So with our coupled handle, that was beautiful. That was really something that you could have made a lot of money on. As far as what we can do right this minute, you've got a situation on your hands where you're looking for a good bullish entry. And it's very simple to trade this stuff once you get used to looking for retracements and moves. And if we get an intermediate term top set up, 55 buys, yeah, we're there. We're there. You're going to get a nice bounce off that level. I almost guarantee it. So, 6 of one, half a dozen of the other. Personally, I would be waiting for a pullback here in one that's interesting to say the least. As far as gold goes, we could certainly just go to price action on gold as well. I feel like we've got a pretty good thing right there at that 41.25 level. That is probably where I would be looking to make my stand, right in there, especially on the weekly chart. I think the weekly gives us everything we need. You'll notice that my time frames are relatively large. And the reason why they're relatively large is because we are going into a slow period of trade. Most of you are going to be out there buying Christmas presents and drinking eggnog and singing and all that jazz. And that's great. That's great. It just isn't really great for the markets. So we've got probably another week and a half of good trading. And then these markets are really going to dry up. And that's going to be a challenge for us. But don't worry, we're going to be just fine. So there's your pullback zone in gold. Let's take a look at my crude oil. Has anything happened? All right there. Let's go ahead and buy a market and see what happens here. WTI futures, interesting trade. We talked about that lower Bollinger Band on a 5-minute chart. There was your bid. Your bid right there was about 59.06. We could already be out of this with the scalp. Let's wait and see what happens. You'll notice that our dome, our trading depth of market, isn't really working. It's not really moving that high. We're down a few ticks. We got a horrible fill on that market order. But let's just wait and see. It looks like this market wants to start breaking out, and we're very, very tight. We're very, very tight with what we're doing today. I would probably be willing to wager that we rotate back up into these guts, the guts of this 59.20, somewhere in that zone. But we don't know. And so if we do see a breakout here, if price goes a little bit against us, we'll hop out. This would probably be what I would call a piranha trade. If you guys are familiar with the piranha, it's in the How to Trade trading room. It's one of the price action strategies that we put out there. So how would I execute this trade in the live market? The first thing I want to do is I don't want to get hit. I don't want to take a big loss on this. This isn't a great trade. So where should I put my take profit? It needs to be reasonable. I need to be thinking probably somewhere right up in here, maybe a 59.23. Let's go ahead and make it even more reasonable. Let's go 59. Let's go 59.20. Let's do that. My stop loss, I could put it beneath this low, which is down to 59.05. Does that give me a decent trade? Yeah, maybe. We can go there and put it at 59.05 and see exactly what happens. So that's a real tight, low liquidity scalp. I don't know that we're going to get paid off here, but we do have reason to believe that the price will rotate sort of back up to our point of control, which is right up in here, right up in sort of the middle of what I would say, right in there. And it doesn't even really have to get there. It just has to bounce up, trade a little bit higher from where we are now, and we get paid. One way that a lot of traders use volumes is in the commodity market. So if I was looking at WTI crude, let's see, where is the time price offering charts? Now we don't want that. We have profiles, time price opportunity. Let's go ahead and put a look in there. Now, what a time price opportunity is it shows you exactly where the volume has been. If you're going to use this on, say, a 5-minute chart, you're probably just going to want to see where the volume's been, over the last, this is really going back just a couple of hours. So what does this really tell us? This is all the price points and all the volume that's come in today on this exchange-traded product. Take a look at it. Essentially, all it is our volume profile laid sideways. Well, what does this tell us? This shows us the price points at where we've done a lot of business. So if I was going to design a profit target in a dead market, what would I be shooting for? You wouldn't want anything over that top line. See this line right here, this white line? That's called the point of control. That's where the most business has been done today. I view those points of control as being a magnet in dead markets. When I take a look at this crude oil market today, I see dead. I don't see any action. I see okay, there it is. There goes the market in our favor. Do we have an opportunity to hit our profit target? Do we have an opportunity? We're right there. We're printing 59.18s. We've got 59.20 there. We've done a very, very good job at reading this market condition. This is a flat market. Crude oil is dead right now. We had an indicator that got us into a rotation. We know we have a ways to go before we get to the point of control or run into the real heavy volume. And this is sort of where we're at now. We had a profitable trade. Look at where we went to. The high of this bar went to 59.20. Now, we did not get filled at 59.20. Why didn't we get filled? The market is slow. This is commodity trading 101, guys. I mean, this is what commodities are. It's a war for every penny, especially in slow markets. So we say, why didn't we get filled at 59.20? I should have got filled there. Well, there's not much liquidity in there. There's not much volume. There wasn't necessarily any buyers there. We want to sell 20s. All right, we want to unload our 20s. We have orders in the market at 59.20. If there's nobody there to take the other side of our order, we're screwed. We can't get out. So right here, we're printing 59.19s, 59.20s. All right, what am I going to do right now? Am I going to wait and hold out for my 20? I don't care that much about it. We're out of here. We're flattening. We're going flat, and we're gone. All right, so what I would highly recommend is when you get your profit target hit a couple of times, go ahead and get out. Because if this thing reverses against us now and stops us out, that's a loss you can't afford to take. Scratch it. Is that hard to do? Hell yes, it's hard to do. It's very difficult. Is there any reason we should have got out of that trade? Absolutely. Cardinal rule of trading, don't make a winner a loser. We hit our profit target twice and we didn't get filled. If this was live market, I would have got out immediately. It would have hit us once, came back, and then went to 19. I'd have been gone at 19. Tough trade in slow markets. That's one reason why you don't always get your fills. We made a few bucks there, though, and that was just a basic strategy. What was it? Bollinger Bands, rotational flat market, playing a return back up to the point of control. These are commodity strategies. The reason why I haven't really got into much of this stuff is because it's too damn hard. You got to have a lot of experience to call a market really well, like what we just did. Not really going to pat myself on the back at all, but to be able to sit in there and say, this is a dead market, we're going to rotate back up higher from here, and then have an entry point, which is my Bollingers, that's a rotational trade. Commodities rotate a lot. They really do. All right, guys. I was going to go ahead and get into the agricultural commodities, but I'm not sure there's any interest there to learn how to trade lean cattle and lean pork. I'll probably just do a separate commodities workshop for just those assets to see if anybody shows up. But essentially, what you're looking at is like your corn markets. You're going to want to definitely be aware of corn in the commodities sector. Relatively straightforward. You're just going corn. ZC is the symbol. Corn monthly, what do you have? Sort of a market that's moving around way down, essentially way down over the past several years. You've got an interesting situation setting up now to where the market's just tightening up into nothing. Do you want to buy or sell corn? I don't know. I'd probably be buying off the yearly lows. That worked. I mean, right there you had sort of this would be the yearly low, and buyer stepped in there. What would you want to do probably the rest of the year? Maybe sell the yearly high. Something right up in there. That would be a great strategy for this corn market. But remember, the thing about corn, beef, let's pull a beef chart. I promise we would. Let's pull let's see, beef. All right, let's go live cattle. Live cattle, typically they go live and feeder. I won't get into it right now, but essentially what live cattle and feeder cattle are just cattle. They're basically steers at different weights. So like a live cattle would be... Live cattle would be the cattle in the pasture, and then feeder cattle is when they take them to the feedlots and they beef them way up. They feed them a bunch of suet and cornmeal and things. Whatever you think about the industry, it's what it is. Interesting stuff right here. This is your live cattle futures. Not really uncommon to see live cattle come off going into the winter months. We're still worried about herd kill and how severe the winter is going to be here in the northern hemisphere in the United States. So a lot of times that can impact pricing. Thus far, it's been pretty warm, so we're thinking maybe we're going to get good herd strength. As far as what we're looking at going into later on in this year, you're probably going to see a bit of a rally as the herd strength numbers start coming in and the winter kill numbers start coming in. And those are reports that are released by the USDA. So you got to be sort of on the ball if you're going to do this. But this right here is why steaks were so damn expensive this year. $240. I mean, that's absolutely crazy. All-time highs, no question. $250. So you need to pull back somewhere down here to the 180s to give us an opportunity to get back to eating rib steaks. Otherwise, there's a lot of hamburger in our future, that's for sure. Or maybe no beef at all. Maybe we'll transition into pork. The pork contract is, lean pork, I believe, is the contract. Pork cutout futures. All right, let's do that. You notice pork much, much lower than beef. Interesting market. I don't trade pork. I don't trade beef or really any of them. They have legitimate margins, though. I mean, you could do it if you wanted to. You have enough money. That's not really a money issue. but definitely one that you'd want to watch. The news. I mean, look at all these news events, key news events, contract switches, news events. It's really difficult. You've got to stay on top. You've got to stay on top of these markets if you're going to trade ags. Very difficult. You also notice volumes. Not a whole heck of a lot of volume there either. So you got to be aware of all that stuff. All right, everybody, that was not the best stream we've ever had in the world because of the technical difficulties. But from a commodity standpoint, I am a commodity trader. I mean, we showed you what I like to do on the crude oil chart, and there it is. 5-minute crude oil chart. My bread and butter for crude would be 30 minutes, something like this. And you'll see how that market profile, that sweet TPO, that time price offering, let's see how that chart works. And you'll notice that point of control, that 30-minute point of control, we were right there on the 5-minute chart, weren't we? So that was a very good trade location to take a rotational play. The only thing that'll make you a loser in trades like that is staying around too long. So you've got to make sure that you understand the difference between taking money responsibly and trying to do something that's not doable. Let's be brutally honest on this trade. I'm going to tell you straight up. You're getting sort of the straight up matter of fact Shane today. I told a trader the other day in a live chat or a private question. I said the number one reason why people lose all of their money in the markets is because they try to fight strong trends. That's the number one reason. All right. The number two reason that people lose all their money in the markets is they make winners losers. They try to stay in a market and make something happen that isn't there. Now listen, we sort of went over what I think the range is going to be today. 147 is sort of our oscillator. So we're looking at a made range of 127. If we get any extension at all, it will be towards the end of the day, probably in about 30 minutes or so. We'll start to see this thing maybe extend the range a little bit. If that is in fact the case, we could be in for a late day breakout. And if you took a long or a short in that, given that scenario, you may be successful. But I hear so many traders, 1 to 2s, 1 to 3s, 1 to 4s, 1 to 5s. I think trading anything that's not evident in the market is a mistake. So if you're a trend trader and you say, okay, I've identified an uptrend. Shane, I want to buy this level. I love it for a 1 to 4, a 1 to 5. I go, great. You're following a prevailing trend. I can get into that. I understand that. If you come to me and you say, Shane, I love a bullish breakout in natural gas over last month's high, I'm going to put on a 1 to 10 because if we go up 20%, which we could do, I'm going to make a lot of money. I can get into that. I could say, okay, yeah, let's do it. All right. If you get the big runner in natty gas and then you're going to go buy a car, I get it. I'm in. I'm all in. Let's do it. But where people really run into trouble, and I'm not singling out anybody in particular online, although I've got 5 names off the top of my head and they do this stuff religiously and it's bad advice. It's bad. It's just bad all the way around. Is they'll pull a 5-minute chart up and they'll say, okay, we got a little bit of a move there. I'm going to buy that lower Bollinger Band and I'm going to put this trade on and I'm going to build something that's a 10X or a 5X or something crazy like that. So the bid is there. The long position is going to look something like this. I see a lot of traders doing this. Okay, there's my 1 to 4 risk versus reward. We're going to go ahead and lock in beneath the daily low, and we're going to go 3 to 1. There's my trade. How often do you think you make that trade work? And is it even there? Is it even available? Look at all the volume. Look at all those sellers you're going to have to beat right in that area to even get to the promised land. And that's a 1 to 3. A lot of these traders will come out and they'll put on a 1 to 5 or a 1 to 6 and they'll go, okay, that's my trade. Now, I can't give anybody advice. Financial advice, definitely not. But I'm going to tell you one thing. This type of trading, anytime you see somebody come at you and say, okay, this is a 1 to 10 payoff or a 1 to 6 payoff or a 1 to 7 payoff, and let's say they're a signal provider, or let's say there's somebody who's a financial guru who gets paid or who builds a reputation off of making these amazing market calls. I'm going to tell you this. They'll hit a few of those a year. Maybe they'll be on a 1-minute chart and they've got it down to where they'll hit a few of those a month. And then they'll point at that and they'll say, wow, we hit a 1 to 10 right here. That's the type of trade we're looking for. That's how we want to build success. In my view, that's incredibly risky. Could you have a good month and hit 3 or 4 of those in a row? Absolutely. Absolutely right. Could you have a bad 3 months and not hit one of them in a row? Yeah. As that risk versus reward gets larger and larger, your capability or your probability of hitting that profit target gets lower and lower and lower. That's interesting to me. That's a concept that it's always been with me. So I'm not necessarily telling you to shoot for 1-to-1s only, but be smart about what you do. If you wanted to have a plus size trade, which is what every textbook in the world tells you, you could have went right beneath that swing low where we had our stop loss, and you could have brought this thing right down here, maybe right around the point of control. Something like this, right around this point of control. Your profit, you're right there. Let's say your stop loss is right beneath that 5-minute bar. Now, your risk versus reward ratio, you'll notice, is huge there. So, I mean, that's not a great example. But what I'm saying is this. I would much rather see you trying to take a 1-to-6, a 1-to-6 from there, where you're only risking a couple of ticks, instead of trying to make a 1-to-6 and catch a move. If you're going to make that work for you over time, you have to catch moves consistently. There are very few people that can do that. You can make a good living as long as you're not greedy. And commodities give you an incredible vehicle to do that. So in my view, if you're not trading commodities, that's okay. You don't have to. You should be looking at them, though. You should say, okay, what's going on? If you're going to pick one commodity to look at, you probably should be looking at gold. Gold gives you information about everything. Gold gives you an idea what traders think of the U.S. dollar, what they think about the risk sentiment in the market, about the topside potential of a lot of assets. Anytime you see gold go up, people are worried. People are worried about inflation, and they're worried about a crash. If you're going to look at one, you look at gold. Crude oil, when you get a little more sophisticated and you want to trade it, that would be one. But anybody that comes to you and says, I trade the euro US dollar and I trade the crude oil exactly the same way. Good luck with that. All right, everybody. Once again, I want to issue an apology for today's stream. It was absolutely terrible. I'm not even sure if we're back online yet. I saw some dropped frames earlier. The audio problem is an issue. I'm going to get that straightened out, and then maybe I'll do a makeup stream later today sometime. But I do appreciate those of you that hung out. I think that we showed you a little bit. I didn't show you too much secret sauce, and I'm not trying to make it a cliffhanger because I can't see any scenario where we talk about the proprietary range numbers, but I can show you how to trade the TPO charts and things, but that's hard. That stuff is advanced, and I feel like we're better served just talking about the broader markets and support and resistance. But if there's a demand for the TPO stuff, I'm more than happy to tell you what I know about it. Market profile is what we used to call it. All right, everybody, I'm going to go ahead and sign off. If you have any questions at all, be sure to show up in the How to Trade trading room. Send me a private message. I will get back to you. Like I said, my apologies for the technical issues at the beginning of this stream. I know that messed up a lot of things with regard to links and all sorts of stuff. So my apologies on that, but it was out of my control. We did the best we could. This is a one-man band. I don't have a producer or a tech squad. So we push the buttons and flip the levers and see what we can do. All right, everybody, have a fantastic trading day. Trade the action well, and we'll talk soon. See you.